second half of this year could be very positive as long as the inflation continues to come in light as it did this week when we just got PPI this morning. Deceleration lower than expectations. Once and if the Fed commits to that rate cutting cycle, my expectations would be Bitcoin would react very favorably to that. The previous smallest cycle ever for Bitcoin was 20x from the trough to the peak. So a 10x would put us around 180K.
Matthew Sigel opens with a crucial reminder: this time is probably not different. History shows that major crypto cycles often end with a leverage-fueled blow-off top. While this cycle may look different on the surface, many of the same patterns are re-emerging, just with more sophisticated players, institutional tools, and deeper capital pools. The mechanisms have matured, but the underlying dynamics remain familiar.
And before that, be the one who says, I was here before 100K. I'm on a mission to hit 100,000 subs before 2025 ends. Help me get there. Subscribe now and drop your thoughts on the market in the comments. Let's grow and win together.
I still lean towards this time is not different. Every cycle tends to end with a leverage-driven blow-off top. And last cycle, the folks who were providing leverage were rather naive from a financial perspective. It was the kind of tech companies like Celsius and BlockFi that got into the balance sheet business, blew themselves up. And we like to use the funding rates in the futures market as an indication of how hot the animal spirits are. When funding rates are above 10% for Bitcoin for more than a month or so, the forward returns look really poor. We had a brief moment of that in December after the election, and then indeed, like the next couple months were a correction for BTC. Maybe some of that was gold taking the lead, and the two tend to take turns. And now in this most recent run up to all-time highs, we're not seeing the type of leverage or overheated funding markets that would typically mark a top. I think that instead it's being expressed via dilution in the equity capital markets. So the stock market has completely changed its attitude towards these companies, and the number of investment banks who are willing to underwrite capital formation in the space has increased dramatically. A big part of that is deregulation. So I think that gets to your point that something's a bit different here. Other parts of Wall Street are kind of acknowledging that the space is here to stay. They should get in the business of underwriting these deals. So it could be that the hangover comes from the equity shareholders of some of these newly formed treasury companies that have enormous paper gains, and then as their shares become unlocked and available for sale, they take profits. And I'm just kind of painting a worst case scenario that a lot of these companies end up trading at a discount to their Bitcoin, and then the only way to kind of restore some shareholder value is to sell their BTC and buy back stock, right? That's kind of what everyone is worried about. That's a scenario that Saylor has kind of taken off the table, denied that he's going to do it, but it might only take one to do it before everyone else feels the pressure. So I still think my gut is that that's ahead of us, and that a lot of these treasury companies kind of won't sustain the MNAV premiums that they're trading at. But I also think that an 80% drawdown is probably too big, and each cycle gets smaller, both the rallies but also the drawdowns. That's kind of a wishy-washy answer, but directionally that's where I am. My base case is that the 4-year cycle holds enough so that second half of this year could be very positive as long as the inflation continues to come in light as it did this week when we just got PPI this morning. deceleration, lower than expectations. Once and if the Fed commits to that rate cutting cycle, my expectations would be Bitcoin would react very favorably to that. The previous smallest cycle ever for Bitcoin was 20x from the trough to the peak. So a 10x would put us around 180K. And that seems feasible to me, right? The volatility has fallen. It hasn't fallen by 50%. So it doesn't seem crazy to haircut the rally by 50% and say 10x to 180. That's the blow off top, and then reevaluate for next year whether, maybe inflation's reaccelerated by then, maybe something in the macro has changed. But that's kind of my base case. If I mentioned that we use the funding rates as a kind of a tactical gauge for when things are overheated or really washed out. We also use the unrealized profit ratio. So although nearly everyone in Bitcoin is profitable, they're not profitable enough to spark kind of widespread selling. So there's that net unrealized profit ratio above 0.7. You really start to, the forward returns really deteriorate. We got close to that in December. Indeed, like Jan, Feb were tough, but we're not back in a range that says, oh, there's a whole bunch of unrealized profits that are likely to be unloaded. It feels like what you said, there's more new buyers, especially the corporates. So on lookout for that to change, but that's my base case.
He draws a sharp comparison to Facebook, which saw an 80% decline during the 2021 to 2022 bear market, a drop investors largely tolerated. Because Facebook represents a 3% weight in the S&P 500, that's a correlated, centralized asset, Bitcoin. By contrast, is uncorrelated and offers uniquely asymmetric upside. So the question is simple: if investors can stomach that level of volatility for a traditional tech stock, why not do the same for an asset with far greater long-term potential?
It still feels very early from my perspective on the adoption of these ETFs for the advisor community, folks who are running money just for kind of regular high net worth investors. A lot of those platforms still can't put the Bitcoin ETFs into their client portfolios without a reverse inquiry. And we're starting to see that change. So the 0 to 1 moment is ahead of many advisors. And what's been so interesting about the recent price action of Bitcoin since kind of the April tariff announcements is volatility has plummeted. Bitcoin didn't have the same drawdown as the NASDAQ. And so for the allocators who work on kind of 60-40 type portfolios and look a lot at volatility as a way of determining sizing of the position, this downdraft in Bitcoin vol is giving them an excuse to maybe take a larger initial position than they otherwise might have. So the reaction to the ETFs from the self-custody crowd is, sometimes rather polarizing. But what I think that crowd misses a bit is when you're a fiduciary and managing money for a client, the temptation to steal the money is just too high if you're self-custodying it, for them. So there's this separation of powers, which, you see at the government with the 3 branches of government, but it also happens in regulated finance where you have to entrust those assets to a custodian to hold on to, and the Bitcoin ETFs made that process much more efficient, fit into the normal workflow of a money manager. So yeah, the flows have been good. I guess they're being overshadowed by the corporate adoption. So in the last year, corporates have actually added more Bitcoin than the ETFs have. That's a big change. So we can get into whether or not that's sustainable or not. But if I think about kind of several legs to the stool for Bitcoin demand, there's individuals, there's institutions, corporates, and then governments. And now with the corporates, we've got another pretty strong leg to the stool. So that seems to be setting a floor here. It's very additive. Now, of course, we're dealing with historical performance. And as we like to say, that's not a promise of future performance. But for every conceivable position size up to, say, 20%, Bitcoin increases the Sharpe ratio. So that's a fancy way of saying that it's better risk-adjusted returns. So yes, it introduces some additional volatility. Bitcoin volatility is, depending on the day, kind of 3 to 5 times that of the S&P 500, but the performance more than makes up for it. So you do notice over history that the drawdowns tend to be larger, of course, when you have Bitcoin, but not enough to make up for the additional returns that you get. So most of these advisors are looking at it in the kind of 50 basis points to 3% weighting. The math, at least the history of it, shows that up to 20%, it's positive, but most folks are more conservative than that. And I like to compare it to a stock like Facebook, which fell 80% peak to trough in the 2021-2022 bear market. Facebook is, roughly 3% of the S&P 500. So whether you liked it or not, you were wearing that 3% drawdown. Do you want that in something which is correlated with the S&P 500 being a major weight in it, or do you want, an uncorrelated asset? And I think that argument is resonating.
Matthew Sigel addresses the ongoing debate between self-custody and ETFs head-on. While Bitcoin purists often dismiss ETFs as compromising the asset's core values, Sigel emphasizes a practical reality: fiduciary responsibility. Financial advisors can't and shouldn't self-custody Bitcoin for clients due to compliance, ethical, and risk management concerns. ETFs offer a critical bridge between the ideals of self-sovereignty and the infrastructure of traditional finance. They're not perfect, but they're essential for Bitcoin to scale into the next phase of institutional adoption. Asterisk ready for more. This next video is a must-watch.